Welcome to our third quarter market outlook. We're going to be talking about the Fed, stocks, inflation, and portfolios in an election year, and a lot of other things as we take your questions and answers. I'm Kara Duckworth. I'm the Managing Director of Client Experience at Mercer Advisors, and I'm very delighted to be joined today by Don Calcagni, our Chief Investment Officer.
Hello,
We
everybody.
have a
Thank you for joining us today.
We've got a lot to cover, but it's important to note that all of this information that we are providing is an informational nature only for your educational purposes, and it should not be construed to be personal financial advice or specifically tailored to your personal financial situation. For details on how this applies to you, your portfolio, and your financial plan, please contact your Mercer Advisors wealth advisor. So, Don, so many things that are top of mind here. I know that we took questions from folks as they registered, and thank you so much for all of you that sent us in so many great questions. We're also going to be taking questions live today as well. So, if you had those as we go along, please submit them into the Q&A function, which you should find at the bottom of your screen. We're going to get to as many questions as we possibly can, and as we go through. So, Don, I'm going to turn it over to you. These are all of the questions that were submitted to us. And I know also the things that we're hearing, both as you and I talk to clients on a daily basis, as our advisors talk to everyone, that these seem like things that I'm sure are swirling around in our clients' minds. So I'm going to turn it over to you to jump into these.
Yeah, no, absolutely. And thank you again, everybody, for giving us some of your precious time today. Yeah, Kara, we're going to touch on a lot of different topics. And so we read all of the questions that all of you have submitted ahead of time. And like Kara said, we look forward to also answering your questions live that you submit through the Q&A function. And so what we did is we took all those questions, we dropped them into to a word cloud tool, and what you see here on the screen, these are a lot of the different topics that are on the minds of our clients: markets, interest rates, politics. Certainly, we are in a very interesting election year, an election cycle. So, Kara, we will do our absolute best to very carefully thread the needle on today's call and just stick to the facts. That's our mission. We're going to try to do that. And so I think it'll be a fun conversation. Hopefully it's very informative for all of our listeners. So I'm going to do my best as I go through the slides here and highlight economic and market data to try to connect those with many of the questions that many of our listeners have submitted to us. So I'll try to do that, and then Kara, you can always raise those here towards the end if maybe I missed one or two of those.
Will do.
So let's begin with this question around the market, right? Equity markets have been hitting new highs fairly recently, but valuations are also high, and markets have become very concentrated. So I want to touch on that, and what does that really mean for us as investors, and how should we be thinking about that? Before I do, let's just touch on some very high level economic data. What's happening in the world, what's happening in the US economy, and so on and so forth. So inflation has continued to come down very slowly, however. We had a very good inflation number last month where it came in at 3%. I have some more data that I'll walk you through here, but inflation has come down dramatically. And again, there's a difference between inflation, disinflation, and deflation. So when I say inflation has come down, I don't mean that prices have come down. What I mean is that the growth rate in prices has come down. That's what we call disinflation. Deflation is when prices actually decline. Okay, so I just want to be clear. I don't want people to misinterpret what I'm saying here. Interest rates still remain at very high levels, 5.5% for what we call the Fed funds rate. Look, this is great for those of you who have savings accounts or money market funds. I mean, we all love seeing these higher interest rates on our cash savings, especially those of us who've been tortured over the past 2 decades, or I should say decade and a half, with near zero interest rates. So, seeing these higher interest rates, for savers is a good thing. However, for borrowers, it's also very painful, right? For those, perhaps who have mortgages, or young couples who are trying to buy homes for the first time, those higher interest rates can be quite painful. The US Federal Reserve, I won't spend too much time on this, but their balance sheet, which is the digital dollars that they have printed to inject into the US economy over the past decade and a half, that has come down, right? So back in during the global financial crisis, they printed cash between 2009 and 2015 and injected that cash into the economy to support the economy. They also did that to help combat COVID, right, in March of 2020. That balance sheet has begun to shrink as the bonds that the Fed owns have matured. They've been deleting dollars from the US economy. So you can see that that has come down quite nicely. I would argue this is a good thing, seeing the Federal Reserve shrink its balance sheet. U.S. stocks, at least as measured by the S&P 500, continue to do very well. Like I said, hit new highs. We'll talk about that here in a few moments. This particular manufacturing index, I won't spend too much time on it, but this number of 48.7 suggests that the U.S. economy, in theory, should be in a recession. But we're not. Objectively, we know that the U.S. economy continues to grow, but the manufacturing part of the U.S. economy looks like it might be shrinking a little bit. And then, Kara, we also had some questions on the U.S. dollar. And so before
Yes.
I leave this slide, I'll touch on that. The U.S. dollar continues to be the world's preferred global reserve currency. Nearly 60% of all central bank reserves around the planet are held in US dollars. So it is objectively true that the US dollar continues to be that king currency that most central banks on the planet want to hold. If you really think about it critically for a moment, there's no other currency around the planet that is really a safe haven. It's certainly not the Chinese yuan. It's certainly not the Russian ruble. And so the US dollar still continues to be the world's preferred reserve currency. The US dollar has risen in value as much as 40% since 2010. It has since come down a little bit since its peak in September of 2022. It's come down about 6% since then. Year to date, it's up another 3.5%. So the US dollar, by any objective measure, is still very strong. It's actually a little too strong in some ways, in that it makes our exports more expensive to the rest of the world that would like to buy US produced goods and services. But the US dollar, by any objective measure, still the world's preferred currency, very strong. Now's the time. If you want to go to Italy or somewhere like that, or Greece, now's the time to do that, because your dollars, your US greenbacks, will certainly go further. All right. Just a couple of more, high-level overview, talking points on the economy. Home prices continue to be quite strong, and for many of us, that seems a little counterintuitive, Kara, right? Like, how is it that home prices could be so high when interest rates on
Yep.
mortgages have gone up quite dramatically? This is really a supply and demand imbalance coming in the aftermath of the global financial crisis in 2008. A lot of home builders really stepped back on production. And so, for the better part of a decade to 15 years, in the United States, we simply didn't build enough homes to keep up with demand. And so what that has resulted in is a fundamental imbalance between supply and demand, almost to the point to where home prices in many local markets are operating independently of what's actually happening in interest rate markets. For example, the interest rates on the 30-year US mortgage. And so that's why, and I feel bad for these young couples that naturally are trying to buy homes, and they're seeing 7.5%, 8% mortgage interest rates. And of course, home prices are still quite lofty. The commercial real estate sector, I know many of you had questions about commercial real estate, is a completely different animal. And in fact, it's in many ways the opposite. We have far too much commercial real estate in this country, given this new hybrid work from home reality that so many companies have adopted in the wake of COVID. And so I'm not bullish. In fact, I'm quite bearish on what's going to happen in commercial real estate. We are beginning to see some pretty steep declines in the prices of some really high quality commercial real estate in big markets like New York and San Francisco and places like that. So commercial real estate, completely different story relative to the story in residential real estate. We'll touch on inflation in a little bit. Unemployment has ticked up ever so slightly here. just recently. And in fact, when we look at inflation coming down, when we look at unemployment beginning to tick up, in many ways, the market has interpreted that to mean that the Fed is getting closer to perhaps cutting interest rates. And we'll talk about that here as well in a few moments. And what does that really mean for investments? The economy, the US economy, like I said, it continues to grow. 1.4% real, that means inflation adjusted GDP growth over the last quarter. The US economy continues to really be the workhorse of the world economy, especially for developed markets. So the US economy in many ways has really defied gravity over the past several years, despite high interest rates, despite supply chain disruptions and so on and so forth. Again, in the wake of COVID, the US economy has continued to really motor ahead in ways that have been quite spectacular. Consumer sentiment. For whatever reason, all of us as Americans, we're just not happy. We are not happy about where the economy is. And I think that might have more to do with the political season that we're in at the moment. But I'm not an expert in social psychology. What I would say is consumer sentiment tends to swing quite a bit depending on just how we feel about prices at the gas pump or prices at the grocery store. And I think it kind of follows that, when you look at these bread and butter items that we consume every day, that, yeah, we're not feeling very good about the economy when you're paying $4 a gallon for gasoline in my home state of Pennsylvania. So, and I won't spend too much time on this, but there's a variety of economic indicators that we at Mercer Advisors on the investment team are constantly monitoring. And so I won't go through all of these, but I will highlight one. And this is the Federal Reserve's perception of whether or not a recession is coming. And this is an interesting point. There is now a rising perception among Federal Reserve members, the FOMC members who vote on interest rates, that our recession risks are rising, right? And that's a big change because until recently, their view was that recession risks were probably declining. So that's a big, at least for us as an investment team, we look at that and say, that's a pretty material change. So I think that's probably the most interesting of all the different metrics that we follow. That's probably one of the most interesting. Like I showed you on the prior slide, we're not in recession today. So I don't want anyone to leave today's call thinking, oh my gosh, Don said we're in recession. No, we're not in recession, right? Objectively, the economy continues to grow. But there are some clouds on the horizon, potentially, right? So let's keep our eyes open and keep an eye on those. So let's talk markets. In terms of actual market returns, the market, at least through the end of June, this data is through the end of June, June 30th, the S&P was up about 14%. This little red dot here, and these red dots that you see along the bottom here, that is the intra-year decline in the S&P 500 index during that particular calendar year. So the calendar years are down here along the bottom. So earlier in the year, the S&P was down about 5%. It has since recovered and is now up about 14% again through the end of June, at least as of today, at least as of yesterday, I should say. It's up about 17% for the year. However, the gains among stocks in the S&P 500 have not been equal. What we've observed is that there's actually a very small handful of companies, very small, specifically about 7 or so companies, that account for the vast majority of returns in the S&P 500 index, not just this year, but candidly over the past year and a half. And these are these artificial intelligence type stocks like NVIDIA and Microsoft and companies like that. And in fact, about 55% of all the gains in the market so far this year come from just those 7 stocks. And so that's pretty significant, right? That so much of the return is coming from 7 stocks. There's another 493 stocks in the S&P 500 index that collectively are up about 7% for the year, whereas these 7 technology stocks are up about 33% for the year. Now, before we get all excited and think, gee, why don't I own those? Kara, we do own those. We own those stocks. We own Microsoft. We own NVIDIA, right? We own Alphabet, yep. Right? We own all of those. By definition, when you own a diversified portfolio, you're going to own those stocks. What's important to keep in mind is you don't own just those stocks. You own lots, right? And that's because we want to bring down risk, right? We want to manage risk. We do that through a diversified portfolio. And before you start asking, well, gee, what really are the downside risks? 7 companies sounds like maybe that's enough. Well, those same 7 companies lost 40% of their value in 2022, whereas the rest of the market only lost 8% of its value. So that's why we diversify, right? It's really to manage that downside risk. Now, over the past 2 weeks, we have actually seen the returns in these companies actually come down. And really, other companies, especially small cap companies, right? These are much smaller companies, have actually begun to outperform these 7 technology stocks. Well, why is that? Why is that happening? Well, first off, the value of stocks ultimately is always about the future expected earnings growth. Nobody cares about the past, right? I know as investors, I'm often asked, well, Don, what did the returns look like over the past 1, 3, 5 years, or even over the past 10 minutes? The past doesn't matter. The market doesn't care about the past. The market only cares about the future, right? And what we're observing is that the earnings projections for these 7 companies are beginning to fall back in line with the same earnings growth expectation as the rest of the market. The reason why these stocks have done so well recently is that their earnings growth was a lot higher than the earnings growth of other stocks in the marketplace, right? So
So,
forget the
so,
story. Yeah, go ahead, Kara.
so Don, so along those lines on the earnings on all these, we've got a question coming in from Richard, and this is, I think, related to probably what you're talking about, given that we just had earnings from Alphabet and things today. Do you think that that has something to do with today's tech sell-off?
Well, I think it does, absolutely, right? Because now we have new information, right? As new information comes in, right? Remember, stock prices change in response to new information, not old information, only new information that we didn't know, right? And so, for example, Tesla was off 17% earlier today. Well, that's because they missed, right? They disappointed, right? The market expected one thing, Tesla came in somewhere else. And that's where the market says, that's not what I expected. And so as a result, we're going to sell, right? And so now the selling pressure outweighs the buying pressure, which is what pushes down the price of Tesla. Okay, so you're absolutely right, Kara. It's the earnings expectations
Hmm.
that drive stock prices, right? And so I think that'd be very important for our listeners to understand. Forget the past. Whatever happened yesterday is water under the bridge. The market doesn't care about that, and neither should we as investors. We should always look at the future. What are the expectations? So that's what we're observing. We're observing that the future expected earnings growth for these companies is coming down in line with the market. And so what that means is that, wait a minute, maybe we should be reallocating and owning other stocks in the market, right? And before I even get to that, I want to highlight something here, right? Because I have oftentimes clients will ask me, Don, why do we own more than just like the top 10 stocks in the market? Why not just own the biggest winners and call it a day, right? My own grandfather used to ask me this, right? Back in the 1950s, they would just own the nifty 50s, the blue chips, right? He just wanted the Dow, right? Well, the problem is you always have these big winners that do really, really well, and everybody gets really excited about them. And we begin to think, you really don't need to own any other stocks, right? When I first joined this business in the mid 1990s, my own grandfather, an Italian immigrant, used to say, Don, you don't need mutual funds. You only need to own General Electric. It's like owning its own mutual fund. Well, General Electric today is actually not even part of the Dow Jones anymore. Okay, right. In fact, GE today is not even a publicly traded company. What they did is they spun off their aerospace division, and that continues to be publicly traded. But GE, Sears, right? Many of us grew up shopping at Sears. I live in a Sears Craftsman home. In the old days, you used to buy one through the Sears catalog, right? Sears was the Amazon.com of the 20th century. Sears is now bankrupt. Right? So Sears is no longer Kmart, right? So point being is that these big high flyers ultimately will fall from grace. Market leadership changes, right? Even for those of us who've been investing since, say, 2000. Remember Yahoo? Let's go back a little further. Remember Netscape? For those of us who are a little older, right? Those companies aren't even around today, right? Google is now a verb. It owns search. So the point being is that these big high flyers ultimately fall from grace, Kara. And so you want to be careful not to overload a portfolio on just those big high flyers. Okay. So I made a comment a few moments ago. We're seeing market leadership actually begin to rotate. In fact, one of the questions that came into the queue was, hey, what about small cap stocks? When are they going to begin to carry their weight? Well, the short answer to that is, well, two weeks ago is when they started to carry their weight. In fact, for the month of July, small cap stocks have outperformed large company stocks by about 6%. This is the most significant outperformance of small companies over large companies since 1986, right? I was in grade school. Okay. So the market leadership has changed here quite a bit. Now, we may be asking, well, wait a minute, why? Well, it's because the market is expecting that given lower inflation print from last month and given the little uptick in unemployment and given the Fed's perhaps rising concern that we're entering a recession, the market is beginning to think, wait a minute, now the Fed has a good reason to begin cutting interest rates. And if they cut interest rates, what that means is that many of these unprofitable small cap companies will actually become profitable again, right? Many of these small companies have debt that is what we call floating rate. Think of a variable rate mortgage. Well, that's what a lot of these companies have. And so as rates come down, what that means is there's going to be more cash left over, which means they can now become profitable. So the market is beginning to rotate into small company stocks on the expectation that the Fed is actually perhaps now much closer to cutting interest rates. Whether or not the Fed actually does is debatable, right? My view at the moment is that inflation still needs to come down. The Fed has a 2% inflation target. Inflation currently is around 3%. So we're moving in the right direction. I don't know that inflation has come down enough to justify a cut. So we will see. Not only that, I think the Fed might be a little bit hesitant to cut interest rates so close to a presidential election. But again, we will see. So I already started to answer these questions on interest rates. So this whole section's on interest rates. What I will just highlight is that today's interest rates are around 5.5%, 5.38 to be exact at the moment. Both the market and the Federal Reserve project that over the next year to 2 years, interest rates will come down quite a bit, right? In fact, there's no projection here that it's going to stay sideways or go up. So it's really a question of when, not if. And we're expecting those interest rates to come down about 2.5%. That's quite a bit over the next 1 to 2 years. And so some of you have asked in your questions, well, gee, when do we think rates are going to come down? This is really our best estimate, right? Is that over the next year, over the next 2 years, we're going to see rates come down. My personal view is the Fed probably would not cut interest rates until December, until after the election. I could be wrong. Maybe they cut rates in September, but I actually think December would be the earliest that the Fed would begin cutting interest rates. There's also a question that we saw, Kara, around, could it be that future interest rate cuts are already priced in to stocks? I actually think the answer to that is yes. Right? The answer to that is yes. Markets price in information that we know. The market knows that the Fed is probably going to cut interest rates over the next 2 years. And so before we get into the whole section on politics, Kara, let's touch on the federal budget. It is an election season. I wish our candidates were talking more about policy and budgets and less about some of these other things. Our government today spends nearly $7 trillion per year. Now, we can debate, is that too much? Is that too little? That's a political debate. What's not political, what is true, is that about 40%, actually almost 50% of our budget alone goes towards Social Security and Medicare and Medicaid. And when we include defense spending, it's even more, right? It's over 50%. Actually, when we look at the federal budget, there's actually not a lot of discretionary spending. It's actually quite low as a percentage of the total budget. So this is how much we spend. Here's how much is coming in, right? So for all of us who used to balance checkbooks, I don't know too many people do that today, but balancing checkbooks, going through the ledger, right? Well, what we see is that we actually have a pretty big shortfall, right, in terms of tax collections, right? So we're actually collecting about 5 trillion in taxes annually, but there's a shortfall. So we have to get out our credit card and issue more bonds, more debt to the tune of almost $2 trillion per year. This is a lot. I would argue it's actually unsustainable. So bottom line here is we spend more than comes in. There's a debate. Do we cut spending? Do we increase taxes? That's why we have elections. All of us, I'm sure, have our views. Kara, one of the big questions in the queue that we saw was, gee, what are the policy differences perhaps between the two parties with respect to the economy and how that might impact markets? Well, President Trump has committed to extending TCJA, the Tax Cut and Jobs Act of, I want to say 2017. I think that's when that was signed. If we do that, and if we don't cut spending to offset the extension of those tax cuts, what it means is that the federal deficit will actually grow. And what it means is our debt and the interest on our debt will grow. So that is objectively true. These are Congressional Budget Office estimates. This is not meant to be political. It is objectively true that if we extend those tax cuts, that will negatively impact the deficit and the debt. That assumes we don't cut spending elsewhere. And I would argue that Congress doesn't have a very good track record when it comes to actually cutting spending. So that'll be interesting to see whether or not the Republicans, should they win in November, whether or not they would actually cut spending to offset the extension of these tax cuts. Kara, you're probably closer to these taxes than I am. So maybe you can walk our audience through, like, what are we really talking about?
Absolutely. And I think specifically we've had a couple of questions, Edward asking about what happens with the tax changes. So as all of you know, the TCJA that was enacted, as Don referenced, actually sunsets starting January 1st of 2026. And I think that's maybe an important thing to talk about. This is the law. This is going to happen on January 1st of 2026, regardless of what happens in the election here in November, unless Congress enacts a law and is signed by the president, this is going to happen. So they very well may pass a law in 2025 that will change this, but I think it's important to keep in mind that the election doesn't influence tax policy, what actually the laws on the books are. So they're important things that I think each of you should work through with your advisor on your tax planning, because they're significant things. In particular, the reduced tax brackets and the high standard deduction is going away in 2026. So you need to look at where that lands you in your tax brackets. For estate planning, if you've listened to any of our broadcasts about that or talked with your advisor about estate planning, we have currently a $13.6 million estate and gift tax exemption. And if you are above that amount in your total net worth, you need to be thinking now on if you want to do some gifting, because if you wait until December of 2025, there's not going to be time to do that when this sunsets. So make sure that you're taking advantage of that. And then some of the other things that may apply to each of you personally, the SALT cap. SALT stands for it is your state and local tax. So things like if you live in a high income tax state, I live in California, it's always on the top of that list, or you have high property taxes, you were limited to only taking $10,000 worth of deduction on your federal tax return, even if you paid more than that to your state or in property tax. So starting in 2026, that goes away, and you would get your full state or local income tax deduction back on your federal tax returns. There's several other things here that are listed that are more related to business, whether it's the qualified business interest deduction, the corporate tax rates, R&D. Those are things, and the bonus depreciation that you want to talk through in your particular case with your advisor. But these are pretty significant things that are going to be changing in tax law with that tax reform sunset in 2026. So your advisor can certainly help you with more detailed projections if you want that, but those are important things to know. And we did get quite a number of questions about that.
Great. Thank you, Kara. Yeah, some pretty important changes on the horizon. But I think, as you rightly point out, this today is a matter of a law, right? These aren't policy proposals from either candidate.
Yeah.
Trump has suggested that he is in favor of extending these. Now Kamala Harris probably in favor of allowing TCJA to expire. So at the end of the day, I still come back to the simple arithmetic that we have a massive imbalance between government spending and the taxes that come in. And before we leave this topic, Carol, I'll just touch on Social Security. We did have a question on
I
the
see a couple
solvency.
here,
Okay.
one from Jack, and we've got quite a bit of those. Doreen, Steve, so
Okay.
good time to talk about that.
Let's tackle it while we're on it. So why don't you ask Jack or someone's question there, and we'll tackle it.
Yeah, so the questions are just, do you think Social Security and Medicare will be cut?
Well, I would say it's true that come 2034, there will the solvency, Social Security and Medicare will become insolvent in 20 sometime around 2034. Meaning, so what exactly does that mean, right? Insolvent does not mean that they can't pay any benefits. What it means is they cannot pay 100% of promised benefits under the current formulas that we have in place. At least according to a study that I read yesterday to prepare for today's call, come 2034, assuming no tax increases and no changes to these programs between now and 2034, there will be an immediate 20% reduction in benefits. There just mathematically, there would have to be. Now that assumes no changes. I would hope that our elected officials get the adults in the room. Let's try to tackle this for the benefit of all Americans. So assuming no tax increases, assuming no changes to those programs, my understanding is just based on all the actuarial assumptions, it is objectively true there will be a 20% cut come 2034 or sometime around there. Could be a couple years earlier, depending on economic growth. Could also be a few years delayed, depending on economic growth and inflation and things like that. Okay.
But Don, before we move off of this TCJA slide, we have a question from Jim about if the TCJA portion of corporate tax expires, so that means corporate rates go up, how hard do you feel that would impact the markets?
I do think that would impact markets. It's always a little difficult to say, well, gee, by how much, right? I think it depends on where does it go to. Now, again, you point out as a matter of law, that piece is permanent. So that would be unexpected, right? Remember what I was saying earlier, that markets respond to unexpected news, right? So that would be unexpected. And I do think that that would negatively impact markets, all other things being equal, which is a little bit of a dangerous footnote because nothing in this world remains equal. Things are always changing, interest rates, valuations, investors' appetite for risk. But if you could hold everything on planet Earth constant for a second and then just raise the corporate income tax rate, I think it's objectively true that, yeah, that's going to put downward pressure on stock prices. Probably not significantly so, but that's debatable, right? What is significant? Is it a 5% decline? Is it a 10% decline? It doesn't change the fact that higher tax rates would negatively impact the value of investments. That we know for sure. Okay. So any other questions there, Kara, that we want to tackle before we move on?
No, I think just some comments, and maybe to clarify, we do have one question about that state and local income tax deduction. Note that that didn't mean that the states got to limit the amount of tax that you paid. I still paid the full amount to the state of California that I was going to pay. I only got a limited amount of deduction on my federal tax return. So it did not imply that I only paid California $10,000. So just wanted to clear that up in case anyone was confused by that.
Great.
So no, Don, let's move on and talk about the inflation coupons because I see a whole bunch of questions about those. Beverly, Tom, Clay, this is a popular one.
Okay, so yeah, definitely a hot topic here during this election season. So let's just look at inflation. What has actually happened over the past couple of years? Well, remember, it was actually in April of 2021 when we started to see inflation really tick up quite a bit. It peaked in June of 2022. It peaked at over 9%. 9%. It has since come down quite dramatically since then, but the declines in the growth in prices has started to level off here this year. In fact, this is one of the reasons why the Fed has been a little slower and more hesitant to cut interest rates, more so than we originally thought. We thought coming into the year the Fed was going to move a lot quicker and cut interest rates more and deeper. There have been no interest rate cuts this year. So the Fed has been looking at these inflation rates and saying, no, these are still too high. Inflation has since come down overall to around 3% year over year growth. So again, inflation, disinflation, we're talking about the rate of change in the growth rate of prices. So this does not mean that the prices at the grocery store have come down. It just means that they've stopped rising as quickly as they once were. Now, when we look a little bit closer at the data, Kara, what we see is we are seeing some deflation. This is when prices actually start to come down. So we're seeing deflation in core goods. Now, remember earlier I showed you that manufacturing number of about 48.7 that kind of suggested maybe a little bit of a recession in the manufacturing sector. That could be true, right? Think of like the price of toasters, right? Or something like that, that we're seeing some pricing pressure there. I think where we all want to see it is at the grocery store and at the gas pump. I know we haven't seen that yet, but this is where we're at with respect to inflation today. Naturally, both sides of the political divide are going to point fingers at one another. I would say that inflation is a very complex phenomenon. I don't believe it's a result of directly a result of government spending. I think these things are a bit more complicated. I don't think this is necessarily a result of corporate price gouging and some of these accusations that get leveled across the political divide. I think this has more to do with massive supply chain disruption and pent-up demand coming out of the wake of COVID. So be
Don,
that
while
as it
we're
may,
talking,
the candidates are going to
well,
point fingers.
yeah, very popular thing to point fingers about for sure. While we're kind of talking about inflation and economics about that, we got a question from Richard about, is stagflation a threat?
Well, stagflation would be high inflation, right? High unemployment and low or negative economic growth. We actually don't see all of that currently. I think it's always a concern, right? And I think policymakers, the Federal Reserve, I mean, naturally, we need to pay attention to those things. We haven't seen stagflation, candidly, since the late 1970s, right? But it was enormously painful, and I think that that is really imprinted on our collective psyche. And I think, you know, Richard is right to ask the question. It's one of the things I'm always curious about is, are we going to see high inflation and low economic growth or high unemployment? Objectively, unemployment is low. It's still close to 50-year lows at the moment. Now, we can debate underemployment and the different measures of unemployment, but at the end of the day, unemployment is very low. So at the moment, it doesn't look like stagflation is on the horizon.
Great, thanks.
Any other inflation questions we want to touch on?
There's a few, but I'm seeing far more of them about elections. So
Oh,
maybe we should move on to
okay.
that so we can cover that. Lots of questions about which candidate would be better, how does it work, how do markets affected by elections, and who's in control. So maybe just a good overview here, Don, would cover a lot of these questions.
So I always like to first look at data, and then I will provide my thoughts here. And Kara, we're going to do our best to thread the needle here and make sure we don't upset our listeners. Let's start with the economy. Who is better, quote unquote, for the economy? Well, here's the data going back to 1947. A lot of data, right? We can debate given years and, you know, but at the end of the day, when we look at economic growth, real GDP means inflation adjusted. So after we strip out inflation, how much did the economy grow in purchasing power? Well, under Republicans, it has grown an average of 2.8% when Republicans had total control. That means they controlled both chambers of Congress and they controlled the White House. When Democrats controlled both chambers of Congress and the White House, the economy actually grew at 4%. So 4% is higher than 2.8. So for all of my Democratic friends out there, here's a talking point that you can take to your Thanksgiving dinner parties, that Democrats, in theory, have perhaps been better for the economy. Now, when government was divided, the economy grew at about 2.7%. And most of the time, meaning 61% of the time, government is divided, right? Rarely does one party control all the different branches of government, right? The two chambers plus the White House. So now, for my Republican friends, let's ask ourselves a different question. Who is better for investors? Who's better for the stock market? Well, under Republicans, the stock market has grown an average of 12.9% annually. Pretty good. And under Democrats, it grew at 9.3%. So again, what I love about this slide is there's a data point here for both sides of the political divide. Republicans, under Republicans, markets have done better. Under Democrats, the economy has done better. So you may be thinking to yourself, well, Don, I don't know what to do with that. Like we're trying to reconcile that with our political beliefs. What I would say is that I think it's at the end of the day, it's ultimately irrelevant which party controls which branches of government. And I know that's perhaps not what we all want to hear. I know I don't always want to hear that. I have my views, Kara. I know you have your views. But at the end of the day, it's true that capitalism works regardless of who is in the White House over time. Markets have been upward sloping. The US economy has continued to grow. If we go back to tax rates under President John F. Kennedy, Kara, I believe the marginal income tax rate when he came into office was 91%. Now, it was a very different tax code, right? I'm not going to get into the particulars. But, JFK, I would argue by today's standards, would probably be a Republican if you actually look at his policy positions, which brings me to another point. I think this data, it's really hard to draw conclusions from because if we look at the tax policies or perhaps the trade policies of Bill Clinton, I would argue, was more a proponent of free markets, a traditionally Republican policy platform item, than, say, Donald Trump, who has been more an advocate of tariffs and more protectionist policies. So at
Well,
the end of the
Don,
day,
can we
yeah,
dive
let's
into that
do
a
it.
little? There's a
Let's do
question
it.
from Lucy about tariffs in particular and how that affects the economy and so forth. It's certainly come up a lot in the election debate. Can you kind of dive into that a little bit?
Yeah, so let's think about what tariffs are, right? It's a tax on goods that are being imported into the United States to be sold to our citizens, to be sold to us, to our friends and our neighbors. Okay. So think about what that means. In Pennsylvania, we have the highest gas taxes in the whole country. Consumers pay those taxes. So it is objectively true economically, right? This is sort of an economics 101 concept that if the US is going to levy tariffs on, say, Chinese imported goods, that will push up prices for all of us. We pay the tariff. That is, like I said, that's economics 101. Think about what that means. Tariffs then are actually inflationary, right? Because they're going to push up prices, right? Now we can debate, is that a good thing, a bad thing? There's geopolitical considerations here, right? In terms of, do we want to be importing technology from China, for example? So there's a lot more that goes into this. Naturally, the government would be raising revenue, so it's a form of taxation. But let's not be confused. We pay those higher prices. Those higher prices would absolutely be inflationary. Whether you think that's good or bad, I think is for all of us to decide independently as voters. But mathematically, that's what would happen. Okay.
Great.
So,
Thanks.
all right. But Kara, I think this begs another point, and that is we should be very careful of consuming or taking a lot of these economic talking points from political candidates at face value, right? So I think you have to dig a little deeper and ask yourself, wait a minute, is this really true, or is there more to the story? Okay.
That's great advice, Don.
So, Kara, why don't we stop here? I want to make sure we have lots of time for more Q&A. I think we've touched on, I know we've been answering questions throughout here, but why don't we just stop here and do a little bit more Q&A?
Absolutely. So I'm seeing a lot of questions here, Don, about the deficit. So at what point, obviously, people are concerned about the deficit. What point do you think that would really start to affect? And we've got questions from Charles. I see another question from Ben, just about is there a dollar amount, or in theory, kind of what are you thinking that the national debt results in a decline, a significant decline in our economy?
Yeah, it's a tough question that candidly there are no good answers for. First off, the debt, so the deficit is the shortfall in any one year. The federal debt is the total sum of all prior deficits that have been financed by the federal government. Um, if you look at the US's debt relative to our GDP, that's our income. That's essentially what I'm talking about here is our debt to income ratio, right? We're just at about 97, 98% currently, which puts us pretty much on average with other developed market economies. So think Western Europe, Japan, all these other countries, averaged together. Japan has the highest debt to income ratio. I think I forget where they're at the moment because it's been changing quite a bit here recently, but was well north of 240, 250%. I'd have to double check on the exact number, but they were objectively, they were the highest. Okay. And that really has weighed on Japanese economic growth for a long time. And it's certainly weighed on their financial markets for a very long time. So I don't know what the actual threshold point is where, gee, the market will start to decline or the US economy will continue to suffer. What I would say is we don't want to know. We don't want to find out. We don't want to play chicken with our debt to GDP ratio, right? So we should be very careful about that as a country. 98% I do think is alarming. I think it's very high, right? So I think that's a concern. What I would say is every dollar that the federal government has to borrow is a dollar that is borrowed from the future. It has to be paid back plus interest. And so if you look at our debt today, which is over $30 trillion, that represents $30 trillion plus the interest that we pay, which is almost $1 trillion in interest annually right now. Those are dollars that otherwise aren't available now to spend on defense, on shoring up Social Security or Medicare, or to fund education, right? Or to fund, veterans benefits, things like that. So, there are opportunity costs here from an economic perspective. I would argue the federal debt is already weighing on economic growth because of the opportunity cost now, right? That's $1 trillion we're spending on interest payments that otherwise the federal government does not have and can't spend on other goods and services for all of us as citizens. So I think it is weighing. I don't know what back to our client's question. I don't know what the magic number is. I would just say we don't want to find out, so we should be very careful.
That's great, Don. Lots of questions about inflation, but in particular, we have a question about how does the money supply influence inflation from James?
Yeah, so inflation is when you have too many dollars chasing too few goods and services. And so naturally, if you have a larger money supply, you have more cash pumped into the economy, you have more dollars in theory. A lot of theory here, James. In theory, you have more dollars now chasing the same number of goods. And so in theory, if the money supply expands, you should have inflation. This is classic Milton Friedman, professor from the University of Chicago, my alma mater, classic Chicago School of Economics would say, well, if you expand the money supply, you should have inflation. And for so long, we thought it was a law of physics that it had to be true. However, the Federal Reserve printed $4.5 trillion between 2009 and 2015, and we had virtually no inflation. In fact, during that period of time, we were more worried about deflation. So I think it's important to highlight that there have been very material and very long periods of time where we have actually tested this proposition that an increase in the money supply should automatically lead to inflation, and it didn't happen. It didn't happen. I do think that the current inflation is in part related to the Federal Reserve expanding the money supply to combat COVID. So I think that naturally has contributed to some degree the inflation that we've experienced here shortly. But what I would just say is we should be very careful. Economics has no laws of physics, right? So the best we have are what we think are logical relationships. Sometimes those relationships don't hold. And from 2009 to 2015, that relationship did not hold.
Well, talking some more about the Fed and the balance sheet. We've got a question about if and you have any insight on why the Fed reduced the pace of the balance sheet runoff in June. Just curious about, commenter says they think it's good the balance was reduced. Just curious about why the pace slowed down.
That's a very sophisticated question. That's a very sophisticated listener. What I would say is I think the Fed was taking their foot off of the brake. It was their way of basically cutting interest rates without telling the world that they were cutting interest rates, right? Because if you think about it, what's happening as the balance sheet reduces, the Fed owns bonds, and those bonds are being repaid. They take those digital dollars and they go into their little magic spreadsheet and they delete the dollars. So what they were doing is they were shrinking the money supply. They stopped shrinking the money supply in June. And I think that was their way of taking their foot off the brake a little bit before actually engaging in interest rate cuts, which tells me that the Fed believes that we're pretty close to that point where it's time to pivot and allow interest rates to come down a little bit, right? So that's just another way for the Fed to bring down rates without actually cutting interest rates.
Great. Um, Now to change directions here a little bit, Don, and talking about the tech stocks. You talked about the Magnificent Seven, how we're seeing kind of a change in that sector. So from question from Jerome and similar question from Reza, how do you participate in investing in tech stocks when investing in individual stocks seems risky?
Great question. It is absolutely true that investing in a handful of individual stocks is absolutely risky. It's riskier than it needs to be. You don't need to do that. The best way to do that is by way of a diversified portfolio that already owns those stocks. And remember, these 7 stocks already make up about 36% of the entire S&P 500 index just based on their value. So, Kara, just by owning a diversified Mercer Advisors portfolio, you already have a very healthy allocation to those stocks. But the nice thing is that you don't own just those stocks. I commented on this pretty significant rotation into small cap stocks here over the past 2 weeks. The great thing is we already owned those, right? We didn't have to try to time the market. We were already diversified into those. So, despite the fact that Tesla's down today, well, we own a lot of other companies in the portfolio that are doing just fine, right? So that's going to help cushion this, 17% sell-off in Tesla from earlier this morning. So that's the right way to do it, is to maintain a very, very well-diversified portfolio. You don't have to load up on 10 stocks or 20 stocks. You want to own lots of asset classes and lots of stocks.
Well, speaking of diversification, now we've still got a lot more questions about that. So we've got a question from John and a similar question from Steve about emerging markets. And so thinking about what emerging market would be, how are your thoughts on that in terms of reallocating going forward to increase diversification, sort of the BRICS versus the US?
Yeah, I mean, we are proponents of emerging markets diversification. So let's just start with that. Now, why would we own emerging markets? Why would we invest in emerging markets? Well, first off, if you just look at economic growth on planet Earth in the years ahead, remember, as investors, we're focused on the future. Economic growth in places like India and Southeast Asia is going to continue to be a lot higher than it is in the United States and Western Europe. Just based on simple demographics, right? Our population growth is very low. In places like India and Southeast Asia, it's much, much higher. So those markets are growing very rapidly. And so just from an investment thesis perspective, those are great places to invest when you have rapidly growing economies. To take it a few steps further, in terms of valuations, US stocks today trade at about 21 times earnings. And this is a number where lower is better, right? You don't want higher, you want lower. If you look at that same metric for emerging market stocks, it's about 12 times earnings. So what that means is emerging market stocks, for every dollar of profits, actually trade at about a 50% discount relative to the same dollar of profits in the United States. So on a valuation basis, those are very attractive. Now let's take it one step further, Kara. If you are concerned that the value of the US dollar may come down, forget collapse and forget all the doomsday scenarios. But if you just think it's going to soften and come down in the years ahead, well, owning non-US assets is a very classic time-tested way to hedge against a decline in the value of the US dollar. So I think there's a lot of good reasons to own emerging market stocks personally.
And I'm going to take one more on diversification here. I've got a question from Barry about, can you talk about how does private equity have a place in a diversified portfolio?
So I am a huge proponent of private markets broadly, which includes private equity, venture capital, private credit. If we actually just look at public markets for a moment, only 1/5 of all of the investment opportunities on the planet are actually publicly traded. To say that a little differently, there's a significant opportunity to diversify beyond public markets by owning private investments. Now, there's a lot of regulations here, Kara. The SEC has strict requirements in place in terms of which investors qualify to invest in different types of investments. We won't get into that here, but I think owning private investments is a nice way to add more diversification to an otherwise public investment portfolio. So what it really does is it gives you access to the full global economy, not just those companies that are publicly traded. So owning private investments makes a lot of sense in our opinion.
I know we're getting close to time here, Don, but I think this is a great question to close on from Sarah. And she says, with the prime political election season coming up, how do we think about markets? How do we think about our portfolios going forward? And are there any actions that need to be taken?
Well, assuming that you've already built a diversified portfolio, assuming you already have a financial plan, assuming that you're already rebalancing your portfolio and doing all the things that as investors we should do because it's just good investment behavior. Assuming you've done all those things, what I would say is I'll tie it back to a comment I made a little while ago, is I think when we look at the data over the past century, regardless of which party controlled Congress, regardless of which party controlled the White House, markets and the US economy have done well. And so I think my parting advice here, and I know this is very hard in the current environment, would be to keep politics out of your portfolio, right? If we look at just the market under the Trump administration from 2017 to 2021, and if we look at the market returns under the Biden administration, markets have done well. Now, there were bumps in there, right? Trump had to deal with COVID, March of 2020. Biden had to deal with this inflation shock. But at the end of the day, markets have done well. The US economy has done well. And again, I know that's not what a lot of us want to hear. We want to hear that our candidate is best. I think the best advice I can give you is keep politics out of your portfolio and be very discerning consumers of information that both parties are sharing with you, because I can assure you that it's probably incomplete or possibly even untrue. And I hate to say that, but when it comes to economics, rarely is there one simple, easy talking point or answer to all of these challenges that we have as a society.
Think that's great advice, Don. We've got so many more questions in the queue, but I know that we're out of time. So if we haven't gotten to your question, we do record them and we will be sharing them with your advisor for our Mercer Advisors clients so that we can continue to have this conversation as well. Additionally, this broadcast is being recorded. So you will find the broadcast on merceradvisors.com under our insights page, and it will be posted in about 3 business days for you to be able to listen again and access this recording. So thank you all for joining us. Thank you for the engagement and the questions as well.
Thank you, everybody.
Bye-bye.